And thank you, Jay, for the invitation. It's an honor to be here today. Going to take a little different turn. When Jay called me, I think in September of last year and asked about the topic, it was at a different price. And you know, we thought about just, you know, marking through the line and ratcheting it down. But yeah, I'm going today to talk about shale oil below $40 a barrel, and specifically what has Apache done to deal with this environment. So I'm going to talk a little bit about on the front end about what we've done, and then we'll dive in a little bit on the economics and what it means, you know, for the industry. With being an E&P company and publicly traded, I've got an obligation. My general counsel is sitting down here in the front row. Make sure I flash our forward-looking cautionary statement. You will find it on our website, so you have been warned that if I say anything you know, about the future, but it's in detail on our website. So I want to talk about, you know, Apache and specifically adapting to the market and how we position for success. In 2015, we streamlined our portfolio. You know, big key steps. This was a process that we've been undertaking for several years. We paid down debt and we strengthened our balance sheet. And you know, what you're going to see in a few minutes, I'll show you some details on that. We aggressively reduced our activity and spending levels to align with the current price environment. And I actually stepped in a little over a year ago and had a falling price environment. We had done an update for investors in the fall of 14 in an $80 price environment. And at the time, we were running 93 rigs. I knew I needed to get down to, you know, sub 40, 50. I had no idea we'd be doing what we, you know, actually ended up completing by the end of the first quarter. But I'm going to get into more detail on that. And then the big key last year, we had to go to work on the cost structure. You know, what obviously was, you know, a $100 environment, we found ourselves in a much lower environment, and now in a $40 environment, we have to continue to work on this. But I'm going to show you we attacked our cost structure at 3 levels, our G&A, our LOE, as well as our capital cost on our existing wells we were drilling. So as we roll into 16, the movie hasn't changed. A lot of what we were doing in 15, now we have to do in 16 for an even lower price environment. And I'll tell you, in 15, we budgeted at 50. This business is even more different at 30 than it was at 50. But as we go into 16, we're going to protect our strong balance sheet and continue on the progress we made last year and, you know, preserve our liquidity. We're going to take advantage of our portfolio. We've got a nice portfolio of conventional and unconventional. And yes, today the word portfolio does become more popular as opposed to pure plays in the E&P space. And I want to talk a lot about conventional and unconventional throughout my talk today. Clearly, the shift has moved to focus on returns, strategic testing. For us, it's advancing new plays, and we plan to be very flexible and opportunistic as we move in, you know, this environment. If you look at the repositioning, just a timeline, and this shows you what we've accomplished, you know, really over the last 2 years. You know, both on the top line, some strategic organizational changes. We're in, you know, second quarter of 14, we added an unconventional group in San Antonio. That group is now about 100 employees. You know, we brought in a, you know, significant amount of Apaches. We've got a center there that's focused on new plays and really on the unconventional side. And I would put our capabilities up against any, you know, any company out there today. In late 14, we did an update to the market in terms of what the world looked like. At that time, it was the November 20th. I will never forget this because it was, you know, the week before, you know, things really started to drop, which was the Friday after Thanksgiving on the, you know, the 28th actually of November. You know, I'll never forget, but at the time we stuck out and kind of jumped out there with an $80 price deck and thought we were being very conservative. In fact, we were, as most of the industry was, you know, using $90 decks at that time. You know, 2 weeks later is a different world, and we've been living in that. And early last year, we had a lot of succession movements. I became CEO and president in January, a little over a year ago. I can tell you since this timeline, we've moved along about 18 executives. So we've had a lot of changeover at the top. We've had 6 new board members join us over the last couple of years. So a lot of change at the board, a lot of change on the executive team, and as well as within the organization. We're down about 22% from where we were a year ago. If you look at, the good news was along this time period, we were able to execute a lot of strategic sales. And, that was one of the key things. We sold over $10.5 billion. We exited Argentina in the first quarter of 2014. We sold some deep water properties in the second quarter. We also then late last year, or late in 2014, had moved some Anadarko Basin, South Louisiana properties. The nice thing about all these transactions, including our LNG, was we moved these before the price, the price of oil really dropped. And then last year we had one more big strategic move. We sold our Australia conventional business, which was predominantly contracted natural gas, which was not linked to oil prices. So, we've done a lot on the portfolio side, and it really positioned us moving into, this environment. The result, it let us reduce, our net debt by $4.9 billion, and it greatly enhanced our balance sheet, as you can see. The nice thing is, as we look over the next 2 years between now and 2020, we find ourselves with only about $700 million of debt that matures. So we're in a pretty unique spot. Additionally, we redid our credit facility last year, and we've got about $3.5 billion of undrawn liquidity, which really sets us up nicely for a lower for even longer time period. So I talk about getting there. It was quite an aggressive challenge. As I mentioned, we took our rig count down by 86 rigs. We really did this over a 2-quarter period. Last year's budget, we reduced almost 70%. In fact, when we announced the budget, it was down 60%. North America, we cut 66%. In the international, we cut 40%. And you can see the impact. I can tell you, this was gearing us to really feather the year in a $45 to $50 world. Which is what we did. I can tell you, as you look forward, and we have not done our year-end conference call yet, have not given guidance on a 2016 budget. Clearly the deck we'll be using is below a $50 deck, which is what we budgeted last year. So you can anticipate, us living more within cash flow and numbers coming down and even further reductions. Yeah, I mentioned the cost structure, and oil prices dropped, more than the numbers on this chart here. But we're really proud of the progress we made. We cut, on average, our well costs are down about 30+%. Some plays are as high as 50%. These were as year-end numbers. I've actually seen numbers come down even further as we come into 2016. Our G&A, we took down 26%. If you look at our gross G&A, which really falls into 3 buckets, in late 2014, or about a year ago, we were running at a rate about $1 billion. Today, we enter 16 at under $700 million. So, we've reduced our G&A over the last 12 months by over $300 million gross, which really makes a difference on the cost structure. Additionally, our lease operating expenses have been down 18%. Those are pretty, daunting numbers, but when you look at what's happened on the crude oil price side, it's not enough. What we find ourselves with today is a very well-balanced, diversified portfolio. We've got an extensive resource base in North America, and it's really anchored by our Permian, where we own 3.3 million acres, and that is where our future growth will come, is in North America. Our international portfolio, Egypt and the North Sea, both generate free cash, and they have years of exploration and sustainability. So we're excited about a portfolio, and I'm going to show you some things now as I dive into a little bit in that. North America, it's a large position, as I mentioned. It's anchored by the Permian, but we've got, positions across 4 acreage plays that are very compelling even in low price environments. The Permian, the Eagle Ford, the Woodford, and the Montney and Duvernay in Canada. All of these plays have, wells that are economic at $40, but I'll tell you, not every well in these plays is economic. And we get into tiering our acreage into Tier 1 and Tier 2, Tier 3, and I'll show you a little bit of that here in the next couple slides. One of the keys to our portfolio, though, is we have a lot of conventional assets in the Permian. It gives us low decline rates and, really helps us in terms of being able to maintain our production. We're clearly continue to stay focused on the cost structure, our strategic testing, and acreage delineation. We're not in a mode today where we're developing and trying to grow. but it's all about setting up for the future. And we're very well positioned to ramp up and deliver strong rates of returns, in the future. And the other thing we did over last year, the last 24 months, was we've added a lot of low-cost acreage. It's acreage that is, off the beaten path. Being here in Vail, you're getting off the runs. It's not on the groomed runs. And it's stuff that we think could be Tier 1 acreage in the future that we've been buying at very low prices where we think we've got a technical advantage and a competitive advantage. So what we find ourselves in, 2016 sub 40, which is really the meat of my talk. What are the options? And the real key to this whole thing is the less cash flow. And with less cash flow to work with, E&Ps can either reduce their activity and mirror to the current price environment, or you can outspend your cash flow, and at which point in time you've got to issue equity, issue debt, or sell assets. And that's the two camps you find companies in right now. And that's really, if you look at the big run-up in price and volumes over the last few years, this industry has been significantly outspending its cash flow. We've taken a prudent approach. We're reducing capital, our program to mirror our activity levels and mirror our cash flow. We're focusing on higher return plays. And we're, as I mentioned, we'll be advancing strategic tests in new plays. And one of the keys is we position ourselves with our spending levels of cash flow where we can remain flexible, be opportunistic, and then ready to react to the changes in the commodity price. We look at our portfolio and rank it in four buckets. And you'll see conventional, unconventional here. Short cycle conventional would be, right now, some of the best economics that we have. The core in the unconventionals would be, the number 2. The long cycle conventionals would be number 3, and then your non-core unconventionals would be number 4. Unfortunately, there's a lot of companies out right now that are caught because of acreage expirations and rig contracts that are running rigs and drilling wells in what we would term non-core plays, and not making, strong economic decisions. If we look at this in our portfolio, we break our plays really into, 2 categories, the conventional, unconventional. And they're, shown here in the green and gold. This is dimensionless on purpose, but it's meant to kind of show increasing impact on the y-axis and economics, either rate of return or NPV on the x-axis. And what you see is a lot of the unconventional plays have a lot more scope and running room. But a lot of the conventional plays have better economics right now. And so you'll see, those are the things that we balance on the capital allocation side. When I talk about conventional and unconventional, here's a pictorial that really shows the difference. The unconventional today, we're actually drilling down horizontally, and you've seen a lot of, from one of the panels that'll be up this evening on the unconventional side on technology, and what it's been able to do is unlock the unconventional reservoirs. But you see in the light blue, the unconventional well is a horizontal. It's drilled into the shale, and you're drilling into the source rock, versus the conventional, which is where this industry was for decades, is the conventional. The unconventional is really controlled by the conversion of the organic material to hydrocarbons, and the key there is the system seal integrity. In the conventional, you've got a breach of the seal. The hydrocarbons migrate into a reservoir. You've got to have a seal there to cap it, and then it's the trap integrity. So having a balance of these types of plays, really makes a difference. The big key I want you to understand, though, is a conventional reservoir is much different than an unconventional. In an unconventional reservoir, it's a dynamic system, and you've got the forces of expulsion that are operative. It's a complex flow system, and you're really dealing on the micro and nano scale. On the conventional reservoir side, it's a static system, and it's the forces of buoyancy. And it's a simple flow system, and you're dealing on the macro and the micro scale. When you look at the unconventional side, the real risk is recovering, the oil economically. And on the conventional side, it's the risk is finding it economically. So you got two different worlds that we live in here. In both cases, the key to maximizing recovery is understanding the hydrocarbon system. The advantages of the conventional side, you got diverse set of projects. They're low decline rates and low operating cost, and they're usually easy to tie back. And as I said, once you find it, it's usually economic. I'll slide on and Next slide here. If you look at the conventional side, it also is much lower decline rate. This just shows a first year shale well with over a 50% decline rate. You get into the Permian, and it's been probably one of the hottest basins in the world right now. Your average decline rate right now, and our decline rate's about 25% because it's a blend of the shale wells and the conventional. What you see is, though, our conventional Central Basin platform has about a 14% decline rate, and that's 46% of our production. So what this does, it gives you a base decline, which is a little easier to replace, and it doesn't require as many wells be drilled and as much capital. So we'll switch back over to the unconventional. What's key to the unconventional system, and what are the global factors that impact productivity? It's the RO, which is really the organic matter maturity, the TOC, which is the hydrocarbon saturation, mineralogy, reservoir thickness, pressure gradient, the fluid properties. This is a big driver in terms of being in the oil window, the wet gas, or the dry gas window. The reservoir characteristics, and then the structural settings are really, really key. This just shows a bunch of unconventional plays, and the point here is one resource play is not like another. And if you jump to a few of the key metrics, in the Wolfcamp, and Apache's here in 4 of them, the Wolfcamp is very thick section. You jump to the Eagle Ford, south of the Arch, you've got high pressure. So these parameters are all key to finding out, where's going to be how you tier your acreage, and where the economics are going to look like. This is a slide we borrowed from Credit Suisse. What it shows is break-even prices. The red dots are at a $60 per barrel world. The green is at 50, and the blue bars are at 40. And what you see is very little works at a play level in its entirety below 40. The few exceptions here, there's a few I'll point out that are really the dry gas plays, the Marcellus and the Utica. These do not need the sensitivity of the oil price doesn't matter. So you see those blue bars jumping up to the same economics as they have at the higher prices. I'm going to dig in and talk about, you're going to see a lot of this on the panel this afternoon about technology, but it's really technology that's enabled us to take the cost structure down, with lower prices. It takes an integrated team. We're using geosteering, the 3Ds being now incorporated into the geosteering as well as the completions, and the technology innovations. The other key is the cost structure. We've got to drive the cost out of the system. This is one play. This is really the punchline that I wanted to get to kind of show you the impact of oil below 40. This is just a generic play, so this is not one of our specifics. And if you look at the bottom box on the left side, we show oil price. I show a well cost at oil price $100. I show a well cost at $8 million. And we would have in this play, and we used a criteria in terms of tier 1, tier 2, in terms of the rate of return on the left side. At $100 oil price and $8 million well cost, we might have had 1,000 tier 1 locations and 5,000 tier 2 locations. Price drops to 40. We don't change the well cost, all of a sudden that 1,000 locations might go to 50 locations, and those 5,000 locations go to 1,000 locations. So the economics get pressed hard. What you've seen, though, is, and a lot of people talk about the efficiencies, with the drop in the price, all the things we're doing on the innovation side with the completions and so forth, you see at $40 now at a $4.8 million well cost, all of a sudden that 1,000 becomes 750 locations, and the tier 2 locations might be 2,800 locations. The keys to driving this are reducing the well cost 40%, which I've shown you we've been able to do. The lifting costs go down, and then the EURs go up because we get better at determining what works in the unconventional side. So if you look at North America, the industry must adapt to $40. The impact of low oil prices really reduces our cash flow, which is the big driver. Even if we can take the economics down on the well level and make them attractive, we have less cash flow, so it slows down the growth rate. And one of the keys to be successful in low prices is going to be fully integrated teams, improvements in technology, and supply chain side. And it requires completion efficiencies to improve our recovery factors. So in conclusion, the industry will continue to evolve. The surviving North American producers will be ready due to the lessons learned and the corrective actions that we've taken. Technology has driven the productivity gains. The efficiencies have lowered our cost. Innovation has improved, and we're in a position now where you will see some transactions, mergers, acquisitions, and asset transfers will create new winners. But most importantly, the adaptive and creative thinking will prevail. Thank you very much.